Speaking of doom and gloom, the last Gen S was sort of asking, well, what do you think of all the news? This was probably in response to our episode about the bubble and or whether or not there was one. Our position was that not really. There's some things going on, but nothing resembling a bubble. But CMHC released their most recent report and changed the risk from the Canadian market from moderate to high, and that included an assessment of our market here in Halifax switching from moderate to high risk as well. Neal, what do you think?
Well, I'm first going to say that there's only 3 levels, by the way. There's low, moderate, and high. Again, I don't know who can see what's on the screen. You can see all the different markets that they looked at. It's basically all the capital cities. So yeah, there's low, moderate, and high. They have done this before with Halifax. CMHC's always had a very weird outlook on Halifax, and I think for the simple fact that they don't have a lot of people on the ground here. And it is a weird market to look at from the outside. The number one thing I think that caused them to say that is they said that the price increases and sale prices that are going on are outpacing kind of the household threshold. So, and they labeled that as the fundamental housing price. So they define the fundamental housing price as what a household should be able to afford based on average expenses and average incomes and things like that.
This goes back to our 35% of gross household income, what we talked about in a previous episode.
Exactly, 100%. And so like that's like their big item. I think it's kind of funny. Like, so they have 4 metrics that they use to combine to give you market vulnerability. And the first one is overheating, and they say that's moderate. Price acceleration, they consider it moderate. Overvaluations, they say are moderate. And excess inventory, they say is low.
Which means there's a shortage.
That means there's a shortage of housing. So honestly, overall, the average is slightly lower than moderate. But then when they combine them all, somehow the market vulnerability goes too high. So I'm not 100% sure how that happens. The only
some
real
of its parts, Neal. Some of its parts.
Yeah.
Right? Something's the sum of its parts.
I get that
a little bit.
Some of its parts. So I mean, a little bit. But then, yeah. So I think the biggest one that kind of stuck out to me is that they said the fundamental housing price is being outpaced. But I kind of disagree. I mean, I think a lot of people are going to give me flack on this. Yeah, incomes aren't necessarily flying up directly immediately as fast because you're looking, let's say you're on a salary and this year you're making 50 and next year you're only going to make 51 or 5,700 or something. But on average for new positions, I would tend to agree or believe that our average wages have gone up by a lot. Like maybe not exactly the 30% like the housing market, but pretty darn close. And I mean, the proof is like Amazon's here now. They're trying to hire. They started their hiring at $15. They couldn't get anyone. $16. I think they're going to like $18 now. So that's 20%. And I mean, that's on the low end, but it's the same with all the professional jobs. You're seeing them having to continuously uptick the offerings to get people on board. All the trades, you used to be able to hire trades at $20, $21, $22 an hour. Now you can't get any good trades under 27, 28, 30, 34. Like I know people working $34 an hour. That's a $70K plus year position now. So I don't know. I think, but it's like everything. Like I think that's going to lag a little bit, right? Like you're going to see that chart showing the wage increases. That's going to take a year or two to really show up. And so they're seeing these house prices go up, and they're not seeing necessarily the wage increase immediately to follow. Additionally, not a lot, but a bunch of the people too that have come here that are buying recently, like the 5,000 that moved in from Ontario. I think it was just this quarter. Was it 5,000 people, I think?
Yeah, I heard some. I don't know the exact number, but yeah.
Yeah, well, of those 5,000, I'd be willing to bet 50% of them are still getting paid in Ontario.
Mm-hmm. Yep.
Like I know of all of my Ontario clients are moving here with a job still in Ontario, working from home and going back and forth. So our numbers don't show anything great, but they're making $125K a year and they're living here.
Well, this is the funny thing about numbers. If you scroll up here for a second, Tanner, look at this on the right-hand side. Evidence of price acceleration detected. House prices increased in 2021 following on their growth in the second half of 2020. House prices increased. Yeah, kind of an odd sentence. Year-to-date average MLS price of a single-family house in Dartmouth has grown by 28%. On the peninsula, 76? By 76%. So, like, that's not accurate.
That doesn't make any sense.
Yeah. That's not accurate. Obviously, you've got some outliers here that have skewed this data, and this is what happens when you have smaller sample sizes. Like, we just know factually that number is not correct. So sometimes you need to be wary about what has been, sampled to get those results. Obviously, you throw a bunch of new construction that takes up a disproportionate amount of the sample size, and you're going to get oddities like that. I think it's also worth noting that, as you can see on the other side, this is the same rating we got back in March. So I can understand Jen's question and concern bringing it up right now because it's recent and it's in the news. But this is also the rating we got back in March, is that we are the risk is high in this current market. The market is vulnerable. Whether or not you agree with that's another question, but this isn't a change since March. The other thing, and I don't see it here anywhere in particular, but in reading articles and reading this report, they said the average house price in Canada had now risen to around 760,000.
760, 77.
Something like that.
767 or something like that.
Which is a lot of money.
Yep.
And it's skewed by these major markets that they're here sampling from.
Way higher than our average.
Yeah. Our average is somewhere in the mid fives. So I'm not saying the mid fives is affordable, mid upper fives, 580, something like that. Is that where we're?
It's lower fives.
Really? Yeah.
I think.
Okay.
But let's say mid fives around there. Yeah.
So I guess the question we need to ask ourselves in Halifax is, well, are we a below average priced market?
Yeah.
I would say we're not. And that means technically we kind of have room to grow before we're pushing on that threshold of, because if you look at these regions that they sample, Victoria, Vancouver, Edmonton, Calgary, Saskatoon, Regina, Winnipeg, Hamilton, Toronto, Ottawa, Montreal, Quebec, Moncton, and Halifax, the reason they sample these is because those are the major markets, which in theory means they can be substituted from one another. If you don't like your situation in Ottawa, you could potentially move to Halifax and have a similar city lifestyle. So we are at the low end of the average across this spectrum. I would argue that we still have some room to grow before we're going to be pushing the limits of what this market will support.
I tend to agree. The big one for me when I start to really get a little bit concerned is, like, especially on the new construction side, because that's where I find the prices get a little bit crazy quick, is when it gets to the point where they're building a bazillion brand new houses and they could technically sell them for less than the other ones they're selling for. Right? Like, so for example, a new construction one today in West Bedford firmed up for $1 million. That sold for 600 2 years ago. They had done nothing to it, just a brand new house. Actually, it sold for 800 at the start of this year, and it resold today for $1 million. But could someone go in that neighborhood, buy that lot, build that exact same house for sub $1 million? Actually, I think they could. And that's where I get concerned, because I'm like, okay, so if the builders were to start ripping through it, there could be some issue there, because then that's when you get that point of like, okay, now there's an oversupply. But we're so far gone on our excess inventory.
Exactly.
That it'd be a long time to get to that turning point. Especially like also what they said, like Clayton Developments ran out of land, which hasn't happened in 160 years, and they are now out of building lots. So it's not like this is going to be an issue that's going to necessarily pop up for us. So again, to kind of reaffirm that I'm not overly concerned. But
it's also dive into the numbers here, because another one of the indicators that they were talking about, oh my gosh, things might be slowing down here, is that the number of new housing starts are down. Well, if there's no land and the builders are so backlogged, how are they going to go out there and asking for new permits and new housing starts?
Yeah.
They can't do it. So is that a reflection of the market slowing down, or the market being so damn hot that we're sold out everywhere? So you can take that data and decide what you want it to suggest to you about the market. I think the fact that housing starts and permits are down is reflective of the fact that, oh my gosh, land is so rare that we can't build homes fast enough, which doesn't mean the market's going to slow down. No. I understand your point, though, and we were talking about substitution when we talked about an assessment of the market in a previous episode. The areas where I'm most concerned about market vulnerability is when you are out buying a standardized product in an outside peripheral area.
Yeah.
Because if people can substitute something else for it, be it a different home that's the exact same or a new home that's cheaper, you might have a problem on your hands. Those are the areas that I do think could be vulnerable, but I don't think they're there yet. I think they...
No, and again, that's where I'm at. I'm saying I don't think we're there yet. I think our prices are touching on that, but at the same time, we have no land availability, so that cranks the value of land up, and we have no builder availability, which cranks the cost of construction up, so maybe they're not.
You felt we were still going to go like this until the spring. Do you still feel that way?
No, I never. I'm thinking...
Tanner, bring up the tape.
God, I don't have to bring up the old tape. I don't think prices are going to maintain to increase. I think we're going to have still... I think we're going to slow down on the price increase. I don't think it makes sense that we continue to price up and price up and price up. I think there's still room to grow, but I think at a much more reasonable. Like I don't think
we're
we're
gonna have to check the receipts.
We are gonna have to check the receipts for sure. I don't think I said that. I think I may have said. I did take some heat from one of the listeners about this. I think there's room for prices to increase, but not at this pace of 30% over year.
Totally. Yeah. I totally agree. Yeah.
And I think the growth is going to maintain consistent for a long time, like many years to come. And our turnover and our inventory is going to stay low. But again, I don't think it's going to be or like 76%. I don't think we can hit 76% year over year. I'm not sure what blue. They must have included like multi-units. That's what it is. It must be like the big multis that get listed because a bunch of big multis sold this year.
Totally. That's obviously
our million plus multis never used to sell. And this last year we've sold like multiple $2-3 million properties on the peninsula, which you'd never see before.
Yeah, and we just designated a bunch of streets as corridor where all of a sudden a home that was worth $500,000 is now worth $1 million. Like so, there's some. Yeah. There's nuance to this stuff that doesn't come out in the wash. I think the takeaways for this from me, just in returning to the question.
Yeah.
One, it's the same rating we got in March.
Yeah.
Two, we're still almost $200,000 below the national average.
Yeah.
And three, I think if you delve into some of the nuances of what they're assessing here, I don't think they all hold water. Also, CMHC has a big. This is going to be coming from my perspective. CMHC likes the idea of rental. CMHC is pro rental from a. They think that more Canadian citizens should be renting and not buying their homes. They don't come out and say that, but that's kind of been a lot to do with their mandate. And I remember because they had a CMHC person here speak to our office, I think it was in 2020 or 2019, I can't remember, but at some point they were projecting a 4 to 6% drop in the Halifax market. Yeah. And I had to explain this to a bunch of people who were like, oh, well, this happened. And we had a 10% increase. Yeah. And they said in our office, like, anyone have any questions for CMHC? It's like, yeah, ask them why they were off by 16%. And that's not a normal margin of error. And I'm not trying to be hard on them. Like, they're great and it's an imperfect science. But you can read from a lot of these what you want. If you're waiting for the market to stall and get a smoking deal, I don't see it.
I love how Chandler always does his little bit of political, just cover my bases.
And then I walk it back a little bit. Just like, okay, I love them. They're great, but they're
the
wrong,
best as I apply for my CMHC takeouts. There.
I will take that funding, CMHC.
But I mean, just to put CMHC on blast. But no, yeah, I think they've made some really inaccurate assessments. And it is a super hard thing to totally gain on, but like, they have an understanding of who's moving here, what the targets are for immigration, all the policies. There should be a little bit more idea, kind of be able to look forward, because this is like the weather. Like they're just, it's completely, sometimes they hit and sometimes they're completely way off.
Yeah, also I go through this list here, okay? Victoria, we shouldn't be as expensive as Victoria. We shouldn't be as expensive as Vancouver, Edmonton, or Calgary. Should we be as expensive or more or less expensive than Saskatoon?
More.
More. Regina?
More.
Winnipeg?
More.
Hamilton?
Debatable.
You've ever been to Hamilton? We should be more. Okay. No offense, Hamilton. No, but that's a suburb. Whatever. Yeah. That should be par. Toronto, we're going to be less than. Ottawa?
Less.
Less. Montreal?
Less.
Quebec?
More. General Quebec?
Moncton?
More.
Yeah. So those are the big markets. We should be somewhere in the middle of them.
Yeah.
And we're $200,000 less than the average cross country.
Yeah.
So I hate to say this, I think we're still going to go up a little bit more.
Yeah. I tend to agree.
So there you go, Jen. There's your answer to your question.
When I was broke, I had rich habits.